So this post from Villi, and I'm going to link it in the show notes and put it in the newsletter today. So take a look at it because it's quite good. He's actually pretty, I think, insightful here. He says you have to do a dance, Jason, because you can't just basically leave a dead company in the wake of one of these deals, because then the regulators will say, well, there's no startup that existed after this. You're clearly circumventing the rules. So you have to leave enough of a carcass that's still breathing behind you. And in the case of Windsurf, people were trying to figure out why there was about $100 million left behind. People were thinking, well, maybe that's because they're trying to make sure the company can keep operating for a while to keep up this kind of facade. Now, in the case of Windsurf, there's some questions. I'm curious what you think about this, but people are saying if you look at the numbers and the cap table and kind of what you would expect the non-vested employees to be holding in terms of value, maybe it's about 100 million. They have about 100 million. Maybe they would shut down the company and then just give out that hundy to the employees.
No, this is actually an interesting rub. If those were an investment from an investor, this is back to the tax treatment issue. You're an investor. Let's say you had put 100 million into the company. Now the company, let's just say theoretically was profitable, didn't need the 100 million. So they got 100 million in a interest-bearing account. They're making $5 million a year just sitting on that money. So you got $105 million sitting there. What they could do is the investors, based on their document, could take their investment back, especially if it was a convertible note, and not pay tax on it, right? Because they put 100 million in, they got 100 million back. There's no gain. So if you think about that, any of the licensing fee that we talked about might have bad tax treatment. They would get that 100 million back. And maybe that note had interest on it. Maybe if it was a convertible note, it had a 5% thing on it, or maybe it had, I'm going to get this much interest on it. So that could make these deals even more possible. What we're seeing in the industry is AI is such a big prize. I would say the AI prize is worth $10 trillion in market cap, right? We see NVIDIA is worth $4 trillion. Let's just say theoretically, the AI, super intelligence prize is worth 10 trillion. It's going to cost 10 trillion in market cap to appear incrementally on top of Google, Microsoft, Tesla. Just could be 500 billion here, a trillion here, 2 trillion there. Just say there was 10 trillion at stake. It's a rounding error for these kind of acquisitions that are sub 50 billion, if you actually believe that. There's a group of people who don't believe it. They believe, I was listening to Adam Curry the other day, and he has a great show called No Agenda with John C. Dvorak, who was like a hero of mine when I was a kid. He wrote the PC Magazine columns.
Yeah. There's
a group of people who actually think like the whole AI thing is a bubble and it's not going to finish the last 20%, which totally makes sense. There is a lot of work left to be done to make these things actually production ready. The people who are building the technology, they believe that last 10, 20%, the important finishing touches that get rid of hallucinations and make things production ready. So the code actually can get produced. Not just it makes the developer 10 or 20% better, but the full job gets done, which, I think I'm in the camp that it will get done. The timeline might be 3 years, it might be 7. But somewhere between those things, each of these massive castles will fall and these cities will fall to AI. And then there'll be job displacement. You will not need as many people, and then you'll need many more companies to emerge to solve other problems to hire those people.